Hello and welcome to this video. Chamath PALIHAPITIYA has ridden the wave of tech boom in a way that is unheard of in the world of investing. His investing acumen has inspired millions, and from 2011 to 2019, he has averaged a return of 32.9%. These exceptional results reflect his unmatched ability to spot market opportunities, and he achieved these results by investing in tech stocks with outstanding growth potential. So Chamath made tremendous gains by investing in tech companies like Slack, Tesla, Sophie, OpenDoor, and Amazon. Also, Chamath invested in Bitcoin and has been very bullish on this non-correlated asset class. So Chamath became a billionaire by investing, but currently he is very skeptical about the direction in which the ship of the market is heading. So according to Chamath,
broadly speaking in the market, I'm a little skittish, yeah. Tech stocks in the fucking toilet. Now I'm kind of positioning myself to hedge myself in this situation.
So I personally believe that his skepticism is justified, and the current macroeconomic outlook is casting dark clouds of uncertainty. At the same time, the stock prices are overinflated, and the housing market in China as well as in USA are on the brink of a collapse. So I don't have a slightest of doubt that we are heading towards a market crash, as we will see later in the video. As we navigate the current data and facts, we will also look at what Chamath thinks about the recent events. I will also give you my own analysis on what is going on currently and why I think that the stock market is tangled in the chains of euphoria and greed. I will also mention several other factors which indicate that we are heading towards one of the worst market crashes in history, with the inflation accelerating at unprecedented rates and the situation of Chinese property market worsening by the day. The uncertainty across the world stock exchanges has increased tremendously, with some experts saying that the China's Lehman crisis may be on the horizon. So the China-based company Evergrande is set to default on its debts, totaling an astonishing 300 billion US dollars, which could lead to a financial chain reaction and create a financial chaos of unimaginable proportions. Furthermore, the piling debts of governments around the world has reached astonishing levels. And many governments in Europe along with USA are trillions of dollars in debt. Government's debt is often analyzed through the debt to GDP metric because it contextualizes an otherwise massive number. Take for example the US national debt, which currently sits at over 27 trillion US dollars. In isolation, this figure sounds daunting, but when expressed as a percentage of US GDP, it works out a more relatable 133%. This format also allows us to make a better comparison between countries, especially when their economies differ in size. This intuitive picture shows the mess that most of the countries in the developed world are. The more the country's debt to GDP ratio, the closer it will be positioned to the center of the infographic. And we can see that most of developed countries are near the center of the infographic. So the infographic shows that many countries have gone down the rabbit hole of debt, and there seems to be no light at the end of the tunnel in which these countries are crawling with their eyes closed as if everything is fine. Now, Cathie Woods believes that we are heading towards a cyclical deflation, and corporate leaders like AMD CEO Lisa Su have a very different opinion as compared to mine, as she has stated that global chip shortage will likely end next year and everything is gonna be fine. No, Chamath seems to be a contrarian, and just like me, he disagrees with everybody else. So first I will go through what Chamath has said, and then I will give you my own analysis of the situation.
I think that most people are under the impression that these are short-term kind of contractions and expansions, and that this is just a thing that needs to get worked through the system as we readjust to a post-COVID world, blah, blah, blah. I think it's different. And the reason I think it's different is if you just look at one thing and one thing only, which is that we have a massive labor shortage in America. And there's an incredible stat that I saw, which was the average hourly earnings of non-manager people in hospitality and travel. And the average salary, the mean salary was around 20 some odd dollars an hour, and it's now 33 bucks an hour. And so what that to me says is that we are going through a really sustained period where you cannot get people to do the work that needs to get done, right? So labor capital, I just think it's getting more and more expensive to get folks to do work. And then there's the raw materials that you use to make anything. And everything that I see is that stuff is going bananas. And so I put these two things together and I'm like, I think this stuff is here to stay. I'm really kind of a little bit of a, and I had not worried. And you can see in every episode before this, I was always consistently like, there is no inflation. You can fade the inflation trade. And now I'm kind of positioning myself to hedge myself in this situation. Europe and the United States, we absorb labor and materials from all around the world, right? We are the net importers. We are the net ultimate buyers of last resort of all of these things. And so if you're seeing inflation in those other, supply-driven economies, they are going to come on shore. They're going to hit us in the face. I think the labor shortage is going to get worse, not better. I think we're going to have to pay people more to get out of it. I think prices are going up. Input costs are going up. Energy costs are going up. So this is it. And I think that we are in a period that will resemble the late 70s.
According to Chamath, we can exploit 3 things that can act as an antidote to the high inflationary situation that we are currently in.
I'm very concerned about medium-term inflation. And so in an inflationary environment, in my very simplistic view of the world, I want to own 3 things. Hypergrowth, because hypergrowth can always outrun inflation. Think of that as like companies that are growing 50+% a year. It's incredible growth, right? Then I want to own cash generative assets. Think of that as like, a great example is like a mining stock. I know that sounds crazy, but it's pretty incredible. And then I want to own non-correlated assets. Bitcoin, Solana, DeSo, a lot of the DeFi protocols, because it's a great counterintuitive hedge against all of this stuff.
So essentially, Chamath wants to rely on high growth companies, assets that generate cash flow, and the cryptocurrencies, which are non-correlated asset class. So now we have already looked at the opinion of Chamath, and now I will tell you my own opinion about the current market crash, why I think we are heading towards it, and what can we learn from history. For those of you who are new to this channel, I am Dr. Subail Khan from Subail.com, and on this channel, my endeavor is to help you in making your money work harder, smarter, and in long term. So we know the way coronavirus lockdown stalled markets all over the world. And since then, the global financial picture has been bleak and the governments around the world are trillions of dollars in debt, as I already explained. So have we already recovered from coronavirus crash? In other words, have the things settled down? I absolutely disagree, and I firmly believe that we are on the brink of a stock market crash of unimaginable proportions. My certainty and conviction is the result of my analysis, and it is not just about the macroeconomic events highlighted by Chamath. This is just one side of the story. The market actors like traders, investors, lenders, and brokers are also giving an indication of the upcoming chaos. The greed and optimism have reached the levels of euphoria, and many experienced investors and experts have identified parallels between the events leading to the 1929 crash and the situation of today. Maury Klein, in his book Rainbow's End, The Crash of 1929, diagnosed the crash in great depth and showed some patterns. I am not surprised at all to see the applicability of his analysis to today's markets. History indeed repeats itself, as we will see shortly. So the first parallel is new listings back in 1929 and the current IPO volumes. The rise of new listings during 1928 and 1929 and current IPO volumes show how similar the 1929 crash was to today's euphoric markets. In 1929, new listings hit record levels. He stated in his book, new listings on the New York Stock Exchange rose from 58 million shares in 1925 to 102 million in 1928. In 1929, new listings hit record levels, with excitement around Wall Street reaching euphoria. And don't take my word for it. Here is the real picture of today's markets. The global IPO market continued to boom in Q3, resulting in the most active third quarter in the last 20 years. In brief, global IPO volumes rose 87% and proceeds rose 99% year on year. A key driver of activity in Q3 was the rebound of the IPO markets in Europe, Middle East, India, and Africa. Technology, healthcare, and industrials once again dominated. For those of you who don't know, an initial public offering or stock launch is a public offering in which shares of a company are sold to institutional investors and usually also retail, meaning individual investors. So the rise of special purpose acquisition companies or SPACs has also added to the boom in new listings. SPAC IPO issuance broke records in first quarter of 2021 with 298 SPACs raising nearly 88 billion US dollars according to data from ICR Capital. And the second parallel is rise in brokerage houses between 1928 and 1929 and the rise in the number of trading platforms in 2020 and 2021. There has also been a rise in inexperienced speculators and traders, something that happened leading up to 1929. As Mr. Klein noted in his book, to practiced eyes, they represented a new breed of gamblers, lured to the market more by hope than experience. Like vacationers at a casino, trying their luck in a game owned by professionals. One goes, two come in. Win or lose, we get our commissions. Between 1928 and 1929 alone, brokerage houses opened 599 new offices. It took the total number of New York brokerage offices to over 1600 in the days before Black Tuesday. This was more than double the number of brokerage houses that were operating in 1925. 2021, the story is no different. New trading platforms are flooding the Apple and Android app stores, including apps like Robinhood, E-Trade, and Fidelity, which serve as the convenient brokerage houses of our time and allow the inexperienced retail investors to buy the shares of hyped companies by tapping the screens of mobile phones without doing any research or analysis. If that is not euphoria, then what is euphoria? And the third parallel is record borrowing levels and short sellers creating generational wealth. In 2021, brokers are dishing out record levels of debt to traders. Also in 1929, the huge impact of the crash was due to people investing what they couldn't afford to lose. And now let's have a look at the short sellers. So during the market crashes, a classical way to profit is via short sale, which is essentially selling the stock you have borrowed from a broker in hopes the price will drop, enabling you to buy cheaper shares to pay off the loan. One famous character who made money this way in 1929 crash was speculator Jesse Stone Livermore. And in the same way, Michael Burry made hundreds of millions from housing market crash in 2008. I would say that you must do your research before investing in any stock. Please have a look at the stock analysis videos which are on my channel, so that you can understand how I conduct value-centric analysis to identify good stocks. I analyze the stocks of companies on this channel with my dimensional value-centric analysis approach, so you can learn from my stock analysis and get valuable insights that you can use in your own research. And my goal on this channel is to help you in making your money work harder, faster, and in long term. Thank you for your time and I will see you in the next video. Bye.